A lot of investors might be wondering how rising interest rates might be affecting their investments. So today we're going to talk about bond funds, and specifically we're going to take a look underneath the hood, see how they operate, look at some of the details, and see how they're responding to this environment. My name is Matt Mockelstead. I'm a lead advisor here at Foster Group, and this is our Financial Perspectives video for the week ending February 18th. Before we get to this really exciting topic, I'm going to first, which I think it's exciting, first talk about some of the news over the last couple of weeks. First off, consumer price index inflation, this continues to be in the headlines. It has risen here through January to a year-over-year change of 7.5%. New claims for unemployment came through here recently, and those came in at 248,000, so just a little bit above expectations. And of course, as we all have seen, military tensions between Ukraine and Russia continue to be ever present on the news and in conversation. It's still a tremendous amount of uncertainty around that event. And probably what I'm sharing now is out of date by the time you watch this. We encourage you, if you have any questions, concerns, reach out to your advisor and have a discussion. Moving on to actual investment markets over the last couple of weeks, here's a look at some different areas of the broad investment universe. I'm just going to walk through them quickly. The first one is this purple line, which is the S&P 500, a widely known index for the US stock market. And it's down just over 3% over the last 2 weeks. This green line is the US investment grade fixed income market measured by the Bloomberg US Aggregate Bond Index, down just over 0.5%. Also down about the same amount is international developed stocks measured by the MSCI All Country World Index. This blue line is the Russell 2000. It's a measure of US small cap stocks or US or smaller companies in the United States. And that was slightly positive over the last 2 weeks. And then the orange line is emerging market stocks. And that was slightly positive over the last 2 weeks as well. So that's just 14 days or 10 days of trading. So if we take a step back and look at year-to-date returns, this is what the picture looks like. I won't go through this all in detail. You can see the returns here on the right, but overall, pretty wide dispersion of returns. Emerging markets doing the best, mostly flat for the year. US small cap stocks doing the worst on this page, and international developed and US fixed income right in the middle. We think it's always helpful when reviewing returns to take a look at context or just to understand how this fits in just a larger picture. And if I go to the next slide, this just zooms us out and looks at 5-year returns. This vertical line here on the right just is a measure of the start of 2022, and anything towards the right is what we just looked at year to date. And you can see that even with the shorter term volatility here this year, some of the big volatility in March of 2020, that investors that have stayed the course over time, even in a 5-year period, have had a pretty good outcome. So transitioning now to our topic, I'm going to go back to the year-to-date slide and focus on the bond market. So we talked about this earlier. This is the Bloomberg US Aggregate Bond Index measuring US investment grade bonds. And it's down just over 3.6% for the year. So we're going to talk about this a little bit and look under the hood of a bond fund and see how it's reacted in this environment. Before we do that, just encourage you, if you haven't already, go back, watch our January 10th Market Perspectives video. Here, Kent Kramer, our Chief Investment Officer, just spend some time talking about the bond market, the Federal Reserve, its actions, the relationship between interest rates and bond prices, yield curves, and a bunch of fun stuff like that. The key point is, though, as interest rates go up, bond prices go down. There's an inverse relationship between those two. What's also true, though, is as interest rates rise, yes, current bond prices may fall, but as interest rates rise, investors now have the opportunity to potentially invest in higher yielding bonds or increase their potential return going forward. And what's nice with the bond fund, a broadly diversified bond fund like the Vanguard Total Bond Market Index, which is what we're going to review here, is that there's a natural mechanism as interest payments come into the portfolio, as bonds mature in the portfolio, they're reinvested into these higher rates. So on your screen is just some interesting details on this individual bond market ETF. Again, the Vanguard Total Bond Market Fund. This fund by itself holds over 10,000 individual bonds. Their collective yield to maturity is just over 2%, and the average duration of these bonds is 6.8 years. So this is an intermediate term bond. What's true about this fund, though, is that even though it's intermediate term, this holds a wide spectrum of bonds in the US universe, including bonds with different maturities. So this here on the right is what we call a maturity schedule. You kind of think it's similar to the concept of a bond ladder, where there's bonds with maturities of 1 to 3 years in the portfolio, all the way up to longer maturity bonds. But what's interesting is that shorter maturity bonds actually are a fairly significant part of this fund. About 20% of this bond fund is in bonds that mature within the next 3 years. So that's in fairly short order. And as those bonds mature, they're just going to be reinvested into the current interest rate environment, which, as we all know, has some higher interest rates. And so we just think this is important to understand, just underneath the hood of a bond fund, how it works, because as you see the returns on your investment statement, for example, not a lot of fun to see a negative return for your bond fund. So just know that in a diversified fund, that naturally over time, you're reinvesting in those higher rates over time to help increase your potential returns. So hopefully that's helpful. Thanks for watching as always. If you have any questions, feel free to reach out to our team at the email here listed on the page. Always feel free to go to our website to get some more information. And on that website, you can also request a meeting with an advisor if you'd like to do that. Thanks.